I want you to imagine, just for a second, walking into any business in your town right now.
Okay.
Like, let's say you walk into a local car dealership.
Right. Pretty standard.
Yeah, exactly. So you walk through the front doors and you step on this sturdy, perfectly clean floor mat.
Sure.
And then you look over at the service bay, right? And the mechanics are wearing these crisp, heavy-duty shirts.
Yeah, the uniforms.
Right. And you wander toward the waiting area. Maybe you walk past a fire extinguisher hanging on the wall. And you glance into the employee break room and you spot a fully stocked, wall-mounted first aid kit.
Yep. All the normal stuff you expect to see.
Exactly. Now, imagine leaving that dealership, driving across town, and walking into a hospital.
That is a completely different world.
Completely. I mean, the stakes are life and death. The environment is super sterile. The pace is frantic. But look down.
You're going to see that same floor mat.
Yes. There is that exact same kind of industrial floor mat. You look at the scrubs on the nurses. You look at the hygiene dispensers in the restrooms, the fire safety tags on the wall.
It's all there. It's basically the invisible infrastructure of the working world.
The invisible infrastructure. I love that phrasing.
Yeah, I mean, it's the connective tissue holding the physical economy together.
And the crazy thing is, as consumers, you and I never think about this stuff. Like, ever.
No, of course not. We just assume floor mats magically clean themselves.
Right. We assume fire extinguishers just, exist on walls. We expect soap to come out of the dispenser when we push the butter.
But if you are the person actually running that car dealership or that hospital, it's a totally different story.
Oh, it's a massive headache. Like a relentless administrative headache.
Because somebody has to manage all that inventory.
Right. Somebody has to ensure OSHA compliance and constantly restock the shelves. And today we are going to reveal that one massive company has methodically, almost quietly, cornered the market on all these boring essentials.
And in doing so, they're generating financial numbers that simply do not make sense.
No, they don't.
I mean, for a company that basically washes laundry and drops off heavy boxes, the numbers are insane.
Welcome to today's deep dive. We are looking at a business operating entirely in the physical blue-collar world, right?
Yep.
But they're putting up profit margins you usually only see from, like, a software as a service provider out in Silicon Valley.
It really is fascinating.
So our mission today is to unpack the Cintas Corporation Q4 2026 earnings call transcript.
Which was a really interesting call.
Super interesting. The goal here is simple, but the mechanics, they're going to take some unraveling for sure.
Right. We need to figure out exactly how this B2B services company manages to achieve tech sector-like profit margins.
Exactly. And we're going to look at what their strategy tells us about the current macroeconomic landscape.
Because it's a weird economy out there right now.
Very weird. And most importantly, we want to look at what you, the listener, whether you're a business owner or investor, what you can learn from their absolute obsession with operational efficiency.
Yeah, they are obsessed. So our primary sources for this analysis are the key voices from that Q4 call.
Right.
We're going to be analyzing the perspectives of CEO Todd Schneider, COO Jim Rousakis, and CFO Scott Garula.
A big three.
Exactly. And what they're reporting is an outstanding close to fiscal 2026.
Which is wild, given everything else going on.
It really warrants intense scrutiny, especially given the, highly uncertain, inflation-heavy macro environment they're operating in.
Yeah, let's unpack the headline numbers because they are staggering.
They really are.
So in Q4 of 2026, Cintas saw their revenue increase by 8.9% to $2.91 billion.
And what's key there is their organic growth rate.
Right. Explain that real quick for everyone.
Sure. So organic growth means growth that strips out the impacts of any acquisitions or, weird foreign currency fluctuations.
Okay, got it.
That organic growth was 8.4%. So they aren't just buying up smaller competitors to artificially inflate the top line.
They aren't masking a dying core business with M&A.
Exactly. The legacy day-to-day operations are actually expanding organically at nearly a double-digit clip.
And the profitability just completely follows suit. So adjusted diluted earnings per share hit $1.29 for the quarter.
Which is huge.
Yeah, that's an 18.3% increase over the prior year.
Wow.
And for the full fiscal year 2026, their adjusted EPS was $4.94.
Which completely blew past their guidance.
Right. Wall Street was given guidance back in March of 4.86 to 4.90, and they hit 4.94.
But here is where the story diverges from public perception, I think.
Okay, how so?
Well, we all know Cintas is the uniform company, right?
Yeah, you see those big white trucks driving down the highway all the time.
Exactly. But when you actually break down where this revenue is coming from, the name is almost a misnomer.
Really?
Yeah, let's look at their largest segment. They call it Uniform Rental and Facility Services. That specific segment saw 7.9% organic growth. But if we break down the revenue mix within that segment, uniform rental only makes up 47% of it.
Wait. Less than half of the uniform segment is actually uniforms?
Yes, exactly.
That is crazy. So what's the rest of it?
The remaining 53% is a mix of facility services.
Like what?
So 20% comes from dust control.
Dust control? What does that even mean?
In industry jargon, that basically means floor mats and commercial mops.
Oh, okay. That makes sense.
Then 16% comes from hygiene services.
Right, so that's like restroom supplies.
Yep. Restroom supplies, heavy-duty hand soap, paper towel dispensers, all that stuff.
Gotcha.
Then 11% is linen, wipes, and aprons.
Okay.
3% is shop towels. You know, those heavy-duty reusable rags used in manufacturing and auto repair.
Oh, yeah, the red ones.
Right. And the final 3% is just catalog sales.
We need to pause and explain the why here. Like, why on earth does a business rent a mop?
It's a great question.
Right. Or why does a mechanic rent a shop towel instead of just going to a big box hardware store and buying a massive box of disposable rags?
It seems like an unnecessary middleman.
Yeah.
Right.
Yeah, it totally does.
Well, it really comes down to liability, chemical complexity, and hidden labor costs.
Okay, break that down for me.
Take the shop towel, for example. In a commercial auto repair bay, those towels are getting soaked in motor oil, transmission fluid, harsh solvents.
Basically a bunch of toxic sludge.
Exactly. Now, if a business buys disposable rags and just throws them in the regular dumpster, they're often violating local Environmental Protection Agency regulations.
Oh, because of hazardous waste disposal.
Yes, and the fines for that are astronomical.
So it's a massive risk.
Right. So by using a Cintas rental program, Cintas drops off clean towels, picks up the toxic ones, and uses specialized industrial-scale chemical laundering processes to clean them safely.
Oh, wow. So Cintas assumes the environmental compliance risk for them.
Exactly.
So the business owner is basically paying a premium to outsource their anxiety.
That is a perfect way to put it. And the same logic applies to the floor mats.
Really? How so? It's just a mat.
Well, a commercial mat's primary purpose is liability reduction. It stops customers from slipping on wet tile during a rainstorm.
Sure.
If a business buys their own mat, who cleans it?
I guess some employee has to drag it out back.
Right. An employee has to drag it outside, hose it down, let it dry. If they do a poor job, the mat degrades, loses its traction, someone slips, and boom, the business faces a massive personal injury lawsuit.
Oh, man. I never even thought about that.
Cintas drops off a freshly laundered, scientifically tested mat every single week. It entirely removes that failure point from the business owner's plate.
Okay, that makes total sense. That completely explains the stickiness of the uniform and facility segment.
Yeah, once you have it, you don't cancel it.
But looking at the transcript, their other two segments are growing even faster, right?
Much faster. Their first aid and safety services segment saw 13.2% organic growth in Q4.
13.2%. Wow.
And their fire protection services segment grew by 10.7%.
That is wild.
Those numbers represent a very, very deliberate strategy of diversification into highly regulated compliance fields.
Which brings me to an analogy, because when I look at this segment breakdown and then I look at the profitability, this looks exactly like a tech ecosystem to me.
Oh, like Apple or something.
Yes, exactly like Apple. Think about the iPhone. The iPhone is the physical hardware. It gets Apple into your life, right into your pocket.
Right.
But once you have the hardware, you are completely locked into the ecosystem. You start buying apps, you subscribe to iCloud, you pay for Apple Music.
And those software services have incredibly high margins compared to physically manufacturing the phone.
Exactly. So with Cintas, the initial uniform contract or maybe the floor mat contract, that is the hardware. That gets them into the building.
They establish that daily physical route.
Right. And once they are locked in, they introduce the App Store.
The hygiene services.
The first aid restocks.
The fire extinguisher inspection.
Yes. And the margins reflect that exact dynamic. Like the overall Q4 gross margin for Cintas was 51%.
Just think about that for a second.
It's crazy. Over 50 cents on every single dollar drops to gross profit.
In a company that operates massive industrial washing machines.
And buys fleets of heavy diesel trucks.
And physically hauls wet fabric across the continent.
Right. It shouldn't be possible.
Well, if we break it down by segment, it gets even crazier. The Uniform Rental Facility Services segment, operates at a 50.2% gross margin.
Okay.
But that first aid and safety segment,
Yeah.
that operates at a staggering 57.9% gross margin.
See, I'm struggling to accept the physics of that.
It's hard to wrap your head around.
How exactly does a physical delivery service squeeze out nearly 60 cents on the dollar? They're paying mechanics to maintain step vans.
Yeah.
They're paying route drivers an hourly wage.
Right.
This isn't just, code living in a cloud server with zero marginal cost of reproduction. This is a heavy physical business.
Well, the analysts on the earnings call actually shared your disbelief.
Oh, did they?
Yeah. Manav Patnaik from Barclays and Tim Mulroney from William Blair, they spent their Q&A time laser-focused on one specific metric to try and understand this.
And what was that?
Incremental margins.
Okay, let's define incremental margin for the listener real quick, because it really is the Rosetta Stone for understanding how Cintas scales.
Good idea. So regular gross margin is the total profit you make on your total revenue after direct costs, right?
Right.
Incremental margin measures how much profit you make purely on the new revenue you generate.
Okay.
So if you made an extra $1 million in revenue this quarter compared to the exact same quarter last year, how much of that specific new $1 million fell straight to the bottom line?
Got it. It's basically a measurement of operational leverage.
Exactly.
Because if a business is truly scalable, they shouldn't have to build a whole new commercial laundry facility or hire an entirely new layer of middle management just to service 10 new customers in an existing territory.
Right. The fixed costs stay flat.
So the profit margin on the new money should be much, much higher.
And for Cintas, it is. They hit a roughly 38% adjusted incremental margin in Q4.
38%. Wow.
And for the full year, they finished right at 30%.
That is incredible.
Looking ahead to fiscal 2027, management is guiding for incremental margins in the 30% to 32% range.
Okay, so they expect it to stay super high.
Yeah, they have a long-term stated target range of 25% to 35%.
Right.
And that gives them the flexibility to constantly invest in capital expenditures while still reliably expanding their overall margins for shareholders.
Okay, but I have to ask, are they just aggressively jacking up prices on their customers every year to hit those numbers?
That's the obvious assumption, right?
Yeah, I mean, if my floor mat contract goes up 10% every year, that would easily explain a 38% incremental margin.
Right. But COO Jim Razakis explicitly addressed that pricing dynamic on the call.
What did he say?
He stated that their pricing is currently at historical levels.
Meaning what, exactly?
Meaning, while they might execute slight localized adjustments to keep up with baseline inflation, the price increases are, in his words, immaterial in nature. Yes. They view relying on relentless price hikes as a short-term, fundamentally lazy strategy that eventually just destroys customer retention.
Okay, but if they aren't extracting the profit directly from the customer's wallet, where's the money actually coming from?
They extract it internally.
Internally? How?
They operate under this cultural philosophy they call positive discontent.
Positive discontent. That sounds like an oxymoron.
It kind of is. It's basically this institutionalized belief that no matter how seamlessly a plant is operating, there is always an inefficiency to be found, isolated, and destroyed.
Oh, wow.
Yeah, they squeeze waste out of their own operations rather than squeezing the client.
Honestly, positive discontent sounds like a miserable way to go through life.
I know, right?
But I guess it's a fantastic way to run a logistics network.
Well, the mathematical result of that culture is just undeniable. CFO Scott Garula walked the analysts through a fascinating breakdown of how they basically defeat the inflation narrative.
Oh, specifically regarding fuel costs, right?
Exactly.
Let's dig into the math on this because this blew my mind. Fuel is traditionally the single biggest vulnerability for a delivery business.
Absolutely.
Like if you look at FedEx or UPS, when the price of diesel spikes globally, it blows a massive hole in their quarterly earnings.
But Garula noted that Q4 was one of the most volatile periods for prices at the pump in recent memory.
Right, gas prices were all over the place.
Yet, Cintas' energy costs only negatively impacted their margins by 20 basis points year over year.
Okay, for context for you listening, a basis point is 1/100th of a percent.
Right.
So a 20 basis point hit is just a 0.2% drag on margin.
Which is basically nothing.
It's essentially a rounding error.
Yeah.
How are they immune to the global oil market?
Garula explained that fuel for their vehicles only makes up about 60% of their total energy costs.
Okay, what's the rest?
Their total energy costs, which includes the natural gas and electricity to run those massive industrial washing plants, all of that combined only represents roughly 100 basis points, or 1% of their total overall revenue.
I need to stop and emphasize that. A company operating thousands of heavy trucks nationwide only spends 1% of its revenue on total energy.
It's insane.
That metric alone explains half their success.
It really does.
Huh.
So just following Gorilla's math here, if fuel is 60% of that 1%, right?
Yeah.
And you see a sudden extreme 20% spike in fuel prices at the pump.
Right.
That 20% spike only equals a 20 basis point hit to Cintas's margins.
Wow.
A 30% spike at the pump is only a 30 basis point hit.
So the risk is highly, highly contained.
Exactly. Gorilla stated confidently that they can easily offset a 20 or 30 basis point headwind just through their other operational efficiency initiatives.
It's like an inflation shock absorber built directly into the financial model.
That's a great way to look at it.
So what are these operational efficiency initiatives? Like, are they investing in robots folding laundry or something?
Actually, yeah. They are heavily investing in automating the blue-collar workflow.
Yeah.
They highlighted several specific technological investments on the call. The most impactful one is a proprietary software they call Smart Truck Routing.
Smart truck. Okay.
This algorithm hyper-optimizes their delivery routes to maximize route density.
Route density meaning what exactly?
It basically means minimizing the windshield time between stops and maximizing the revenue generated per linear mile driven.
So less time driving, more time dropping off and getting paid.
Exactly.
Yeah.
And they also utilize automatic sortation technology in their washing plants.
Okay, so that is kind of like the robots doing laundry.
Pretty much. Yeah. Instead of human beings reading tags and sorting thousands of identical blue shirts by hand, optical scanners sort the garments instantly.
That saves a ton of labor. And didn't they also mention something about proprietary garment sharing programs?
Yes, they did.
What is that?
So that involves standardizing the sizing, coloring, and threading of the garments they purchase from manufacturers. If a customer cancels a contract, Cintas can take those gently used uniforms, professionally launder them, and seamlessly reissue them to a new customer on a completely different route without having to purchase brand new inventory.
Oh, that's smart. It drastically reduces their material costs.
Huge savings, yeah.
Okay, but I have to challenge the premise here.
Go for it.
There has to be a physical limit to this, right?
You would think so.
I mean, at what point do you run out of juice to squeeze from a delivery route? You can only optimize a truck's path so much before the laws of physics take over.
Right, the truck can't teleport.
Exactly. The truck cannot safely drive any faster. The driver cannot literally sprint from the parking lot into the dealership any faster than they already are.
Very true.
So if they refuse to aggressively raise prices on their customers, how can they continually promise margin expansion to Wall Street without eventually degrading the quality of the service?
Like cutting quarters.
Yeah. I mean, you can't shrinkflate a fire extinguisher inspection. The fire marshal does not care about your incremental margins.
No, they definitely do not. Well, the answer to your question lies in understanding the sheer scale of the unpenetrated market they're operating in.
Okay.
It comes down to their total addressable market, or TAM.
Let's talk TAM.
During the call, Jim Rasakis highlighted a statistic that fundamentally changes how you view their growth potential.
What was it?
He noted that there are 20 million businesses in North America.
Okay, 16 to 20 million.
And Cintas currently serves a little over 1 million of them.
Okay, see, that metric requires some skepticism, in my opinion.
Why is that?
Because they are treating every single registered business as a viable target. That 16 to 20 million number includes the local neighborhood lemonade stand, the freelance graphic designer working from a laptop in their bedroom, the one-man plumbing operation.
Right, they aren't all going to need 50 uniforms.
Right, they are not all viable customers for a commercial uniform and fire safety contract, so what is their realistic market?
Well, Todd Schneider actually anticipated that exact skepticism on the call, and he added another layer of data.
Oh, did he?
Yeah. He said, look at the labor force. Of the roughly 180 million people physically going to a workplace in North America,
okay,
Cintas only has 5 million wearers in their uniform programs.
5 million out of 180 million.
Right. And even if you remove all the white-collar work-from-home employees who are sitting in sweatpants.
Like us.
Exactly. The pool of blue-collar, service sector, and healthcare workers who require a standardized physical appearance or protective gear, it is tens of millions deep.
Wow. Okay, that makes sense.
So when you ask how they can keep growing without hitting a physical ceiling on rate optimization,
yeah,
the answer is that the runway is so unbelievably massive They don't need to squeeze their existing customer tighter.
They just need to add the business next door to the exact same route.
Precisely.
Which leads perfectly to the psychological brilliance of their sales model. I actually call it the redirect strategy.
The redirect strategy. Tell me about that.
Well, when Cintas approaches a potential new client, they are not trying to convince a business owner to take on a brand new, out-of-the-blue expense.
Right. They aren't selling luxury add-ons.
Exactly. They aren't pitching virtual reality headsets or like executive retreats. They are targeting necessities the business is already spending money on.
Because every physical business operates with structural friction.
Yes. They already pay for hand soap in the bathroom. They already pay a local vendor to inspect the fire extinguishers. They already have employees buying work clothes out of pocket.
Yep.
So Cintas walks in and delivers a very specific pitch. They say, you are already spending this capital and you are likely managing it poorly.
Which is usually true.
So redirect that existing spend to us. We will execute it better, we will do it cheaper through economies of scale, and you will never have to think about it again.
It's a very compelling pitch. And Jim Razakis actually provided 2 phenomenal case studies on the call that illustrate exactly how this redirect strategy operates in the real world.
Let's hear them.
The first one was an East Coast specialty trade sector example.
Okay, so like a plumbing or electrical company.
Exactly. This was a mid-sized company where the employees were required to purchase their own workwear to meet the company's baseline appearance standards.
Oh, man. Anyone who has worked a blue-collar job knows exactly how that plays out.
Yeah, it's a mess.
One guy goes to a discount store and buys a dark blue shirt. The next guy buys a faded navy shirt. Someone else wears a shirt that gets a tear in it, and they just keep wearing it because they don't want to spend their own money to replace it.
Right. The workforce never looks unified or professional.
Never.
So ownership at this company realized the daily reality was falling far short of their corporate expectations. And they reached out to Cintas.
And what did Cintas do?
Cintas introduced them to a specific product line called Comfort Flex Pro garments.
Comfort Flex Pro. Sounds nice.
Yeah, these are high-quality, professional, highly functional pieces of workwear designed for intense physical labor.
Okay.
And once the employees actually wore them, they loved the mobility and the quality.
But the outcome wasn't just aesthetic, right?
No, not at all. The management of this specialty trade company realized the uniforms were of such high quality that they integrated the Cintas uniform program directly into their recruiting strategy.
Oh, that is brilliant.
Yeah, in a super tight blue-collar labor market, they started advertising. Come work for us. We provide top-tier Comfort Flex Pro gear at no cost to you.
Wow. So Cintas took a messy, decentralized liability, which was employees buying their own cheap shirts, and turned it into a corporate asset for the client.
Exactly. They elevated the brand while solving an administrative headache.
That's a great case study. What was the second one?
The second case study Razakis shared is even more revealing regarding how Cintas rapidly expands their margins. It's an absolute masterclass in cross-selling.
Oh, this is the retail automotive customer.
Yes. So Cintas had been providing uniforms to this multi-site retail automotive customer for over 20 years.
Long time.
Long relationship. During a standard quarterly business review, Cintas sat down with the client's corporate management to discuss their broader operational challenges beyond just uniforms. And the client mentioned a major frustration. They wanted their local general managers to stop wasting hours every week on administrative tasks and get back to their core competency, which is obviously selling and servicing cars.
Right, because those general managers, they are highly compensated individuals.
Exactly. But they were spending hours logging into this clumsy internal portal to order toilet paper, hand soap, floor cleaner, and personal protective equipment, or PPE, like nitrile gloves and safety glasses.
Right. And they were ordering it through a separate corporate distribution center.
Yes. They were basically functioning as inventory clerks instead of dealership managers.
Which is a huge waste of talent.
So Cintas recognized the inefficiency immediately. And their response was super straightforward. They just said, we are already pulling one of our step vans up to your dealership every single week to drop off the mechanic uniforms.
Right.
Why are you paying a general manager to order soap from a centralized distribution center? Just let us take over the entire inventory management process.
It's so obvious in hindsight.
Totally. So they trialed it at a few initial locations, and the automotive client instantly realized the massive reduction in wasted labor hours.
And what happened?
They redirected all of that existing hygiene, chemical, and PPE spend away from their legacy distribution model and handed the entire portfolio directly to Cintas.
Ooh.
Boom. Cintas leveraged the fixed cost of their existing route presence to add highly profitable recurring revenue.
Because the truck is already in the parking lot.
Exactly. The driver is already walking through the front door. Dropping off an extra box of nitrile gloves and a gallon of hand soap adds literally zero incremental travel cost.
But all of that new revenue drops straight to the bottom line.
Yep.
This sounds exactly like a Trojan horse strategy.
I guess so.
Cintas gets inside the fortress by offering a basic, undeniable necessity like, you need floor mats so people don't slip in the rain. We'll handle the floor mats. But once they are inside the walls, they start looking around. And Todd Schneider explicitly noted this on the call. He said their employee partners, meaning the delivery drivers, they have eyes, ears, and minds.
I remember that quote.
Yeah, they are inside the customer's business every single week. They are trained to observe and spot every other operational inefficiency that Cintas can absorb.
That's true.
It honestly makes me wonder about their corporate structure. Is their most effective sales force actually their delivery drivers rather than the executive team sitting in the corporate office?
Functionally, yeah, the route service representative is the tip of the spear.
Wow.
Because the psychology of the interaction is entirely different from a traditional sales pitch. The route driver is not viewed as a commissioned salesperson by the client.
Right, their guard isn't up.
Exactly. They're viewed as the reliable, helpful individual who drops off the clean mats and restocks the first aid cabinet every Tuesday at 9 a.m.
Right, there is a deep established relationship of trust.
Yes. So when that driver points out, hey, I noticed your paper towel dispensers are constantly jamming in the customer restroom. I can swap those out for our commercial grade models next week if you want.
That does not register as a high pressure corporate sales tactic.
Not at all. It registers as a helpful vendor offering a solution to a daily annoyance.
It completely bypasses all the traditional corporate procurement defense mechanisms.
And because the delivery infrastructure is already paid for by the uniform contract, that new hygiene contract generates that massive 38% incremental margin.
It's the compounding power of cross-selling layered on top of route density.
Exactly. It's a beautiful machine.
It is. But that strategy is robust, but it brings up a broader question about the macroeconomic environment for me.
Okay, let's pivot to macro.
Because we are operating in a deeply weird economy right now. Inflation remains sticky, interest rates are completely unpredictable, and analysts are constantly debating the likelihood of a recession.
Oh yeah, the R word is always hovering.
Right. So how recession-resistant is a business model that fundamentally relies on human beings having physical jobs to wear the uniforms?
That is the million-dollar question.
If unemployment spikes, doesn't Cintas take a massive direct hit?
That was a major point of contention during the Q&A session. Analysts George Tung from Goldman Sachs and Will Chi from RBC Capital Markets, they directly challenged management on this.
Oh, they brought it up.
Yeah, they pushed on macroeconomic uncertainty, tightening customer budgets, shifting hiring trends, all of it.
And how did CEO Todd Schneider respond?
He offered a very confident response that essentially decouples Cintas's fate from the National Jobs Report.
Really? How can he do that?
Well, he pointed out that they read the exact same economic doom and gloom reports that Wall Street reads, right?
Sure.
He acknowledged the macro data, but he emphasized that while Cintas obviously prefers a booming GDP and high employment, they're not strictly tethered to national employment figures to generate growth.
Wait, how is that possible?
Historically, Cintas has demonstrated the ability to grow in multiples of employment and GDP.
What does that mean in plain English?
It means if the national GDP grows by a sluggish 2%, Cintas has mechanisms to grow at 8%. Even in periods of flat employment, they find avenues for expansion.
Okay, that goes straight back to the TAM argument we were just talking about.
Exactly.
Because if the broader economy shrinks, they don't have to rely on their existing hospital or dealership clients hiring more nurses or mechanics.
Right.
They just deploy the sales team across the street to convert a competing business that is currently buying their own uniforms from a retail store. They just turn them into a new Cintas rental customer.
Precisely. Furthermore, the uncertainty of a hostile macro environment actually functions as a tailwind for their specific service model.
A tailwind? How?
Think about it. When business owners are stressed about inflation and margin compression, what do?
They cut costs.
Right. They desperately look for ways to reduce administrative burdens, consolidate vendors, and refocus their limited energy on their core competencies.
Oh, I see.
Outsourcing the unglamorous facility management tasks to Cintas becomes a highly attractive operational lever to pull, when a company is trying to lean out its own management structure.
That is fascinating. So a recession might actually push more business to them.
Exactly. And beyond just surviving a recession, there is a deeper structural reason for their resilience.
What's that?
Schneider outlined a 25-year pivot in their customer base that perfectly mirrors the broader macroeconomic shift in North America.
Oh, this is the goods versus services thing.
Yes. Schneider provided this vital piece of historical context. He pointed out that 25 years ago, a massive 70% of Cintas' customer base consisted of goods-producing businesses.
So manufacturing plants, heavy industry, automotive assembly lines.
All right, and only 30% were services providing businesses.
Okay.
Today, that ratio has completely inverted. Today, only 30% of their customers are goods producing, while 70% are services providing.
Wow. So they successfully evolved from a company that primarily washed greasy overalls for factory workers into a company that services hospitals, luxury hotels, and university campuses.
Exactly. They rode the wave of American deindustrialization and came out stronger on the other side.
That is impressive foresight.
Very.
Yeah.
And they are highly intentional about targeting strategic, high-growth verticals within that service sector right now.
Did they mention which ones?
Jim Rasakis detailed their aggressive focus on 4 specific areas: healthcare, hospitality, education, and state and local government.
The big 4.
Yeah, and he noted that all of these verticals are currently performing well above the overall corporate growth rate.
Let's isolate healthcare for a second, because I know an analyst from AllianceBernstein specifically pressed them on this sector during the call.
They did.
Healthcare is arguably the only vertical in the modern economy that reliably adds jobs, regardless of what the broader stock market is doing.
Because of the aging population.
Right. We have an aging population, constantly expanding medical needs. But how is Cintas actually attacking the healthcare vertical? Are they just passively mailing brochures to hospitals and waiting for them to call for some floor mats?
Not at all. Schneider made it explicitly clear that their approach to healthcare is deeply, deeply structural.
Okay, what does that look like?
They do not just take their standard manufacturing service model and try to apply it to a hospital. They've organized an entirely separate operating apparatus around it.
Oh, really?
Yeah. They've created dedicated product lines specifically engineered for healthcare environments.
Like what?
Specialized scrubs, isolation gowns, antimicrobial linens, stuff a factory would never need.
Right.
They have tailored service models to deal with the complexities of infection control and JCHO compliance.
That's smart. The liability there is huge.
Massive. They even designed dedicated routing structures exclusively for healthcare clients because they recognize that the daily operational rhythm of a trauma center is fundamentally different from the operational rhythm of a Ford plant.
Well, yeah, the hospital never closes.
Exactly. So they adapt the entire logistics network to fit that reality.
Okay, I want to bring up the ghost in the machine here.
The ghost in the machine, let's hear it.
Because Jason Haas from Wells Fargo asked a question on the call that, to me, strikes at the existential core of a business reliant on human labor.
Ah, the automation question.
Yes, the automation question. If factories, warehouses, and even service businesses are increasingly automating, I mean, if they're replacing human workers with robotics on the assembly line or AI in the back office,
Right.
doesn't a company that relies entirely on human wearers face an insurmountable existential threat?
It's the most logical bear case against the stock, honestly.
If a logistics warehouse goes from employing 500 human workers to employing 50 humans and 450 autonomous robots, that is 450 uniform contracts vanishing permanently.
Yeah.
Overnight.
Yep.
So how did Schneider counter the threat of automation?
Well, Schneider's perspective is that this is not actually a new phenomenon for them.
Really? How not?
He pointed out that the manufacturing sector has been aggressively automating for over 4 decades. And the impact of that continuous automation is already fully baked in Cintas' historical run rates and financial models.
Oh, I see. This connects directly back to that 25-year pivot from goods to services we just talked about.
Exactly. Automation disproportionately cannibalizes manufacturing, the goods-producing sector.
Right.
But because Cintas foresaw this trend, they've already shifted 70% of its business into the services sector. They're targeting healthcare, education, hospitality.
And those industries require intense human-to-human interaction.
Empathy, physical care, things that are vastly more difficult to fully automate.
You can't have a robot change a bedpan, at least not yet.
Right, exactly. So they have deeply insulated their revenue streams. And Schneider also reiterated the TAM argument again.
The 16 to 20 million businesses.
Yes. Even if a specific factory completely automates tomorrow, with 16 to 20 million total businesses operating in North America, the runway of unserved human-operated businesses is just so overwhelmingly vast. They simply do not need to worry about robotics capturing their specific market share in the near or medium term. There are millions of businesses still buying paper towels at the grocery store that Cintas can go acquire while the factories automate.
It is the ultimate pragmatic defense.
Yeah.
It's basically saying, yes, the robots are coming for the factories, but we only serve a fraction of the market anyway, so we will just go sell to the service businesses while the robots take over.
Pretty much. It speaks to a management team that just refuses to be paralyzed by hypothetical future technological headwinds when there is actionable, highly profitable growth sitting right in front of them today.
Speaking of actionable growth, we have to talk about the major strategic maneuver currently in motion.
The big M&A elephant in the room.
Yes, the pending Unifirst acquisition.
This is a huge deal.
Massive. Back in March, Cintas announced a massive agreement to acquire Unifirst, which is one of their primary competitors in the uniform rental space. But these mega mergers, they frequently get bogged down in regulatory purgatory. Where do things actually stand as of this Q4 earnings call?
Todd Schneider provided a very, very carefully calibrated update on this.
What'd he say?
Well, the transaction was officially approved by Unifirst shareholders back in June.
Okay, so the shareholders are on board.
Yes. However, as the market widely anticipated, the deal received a second request for information from the Federal Trade Commission.
Okay, for context for the listener, a second request means the FTC is initiating a deep, exhaustive investigation into the merger. They want to ensure it does not violate antitrust laws or create an anti-competitive monopoly in local uniform rental markets.
Exactly. It is a standard but incredibly burdensome and expensive regulatory hurdle.
Right, because if you have two major uniform providers in a mid-sized city and they merge, does that local hospital suddenly have zero leverage to negotiate prices? That is what the FTC is scrutinizing.
Spot on. Now, Schneider noted that this regulatory scrutiny is very similar to the process Cintas navigated when they successfully acquired G&K Services several years ago.
So they've been through this gauntlet before.
Yes. And management stated they remain optimistic that the deal will finalize and close during the second half of calendar year 2026.
Okay.
However, he firmly shut down further probing from the analysts.
Really? How?
He stated that to avoid generating market speculation, they would not be providing any additional commentary on the regulatory back and forth going forward.
Wow. That was a polite way of telling the analysts, we will update the market when we have an answer. Stop asking us.
Pretty much.
But how is a company of this size supposed to operate while trapped in this state of limbo?
It's tough.
Because Seth Weber from BNP Paribas asked a really vital question about their capital expenditure, or CapEx. If you are Cintas, do you intentionally slow down your internal investments, like buying new delivery trucks or building new washing facilities?
While you wait to see exactly what physical assets you might inherit from Unifirst.
Right. Yes. Why buy a truck if you're about to inherit 1,000 of them?
Well, both Scott Garula and Todd Schneider jumped on that question immediately to dispel any notion of hesitation.
What was their answer?
They clarified unequivocally that they are operating Cintas and Unifirst as two entirely separate parallel businesses until the deal officially crosses the finish line.
Oh, wow.
Yeah. Cintas' CapEx remains robust and incredibly steady, locked right in their historical target range of 3.5% to 4% of total revenue.
Okay, but what exactly are they spending 4% of nearly $12 billion on every single year?
It mostly goes toward heavy infrastructure.
Like the plants?
Yeah, they're building new, hyper-efficient laundering facilities. They're upgrading their massive fleet of step vans to newer, more fuel-efficient models. And they're investing heavily in the automation technology we discussed earlier.
The optical sorters and the smart truck routing software.
Exactly. They are not slowing down their own internal evolution or allowing the pending merger to dictate their operational tempo.
So they are basically executing their playbook as if the deal might fall through, just in case, while fully expecting it to succeed.
Right. And that supreme confidence is really reflected in the guidance they issued for fiscal year 2027. Let's break down exactly what they are promising Wall Street for the next 12 months.
Yeah, let's look at the guidance.
The FY 2027 guidance is very aggressive. They are projecting total revenue in the range of $12.1 billion to $12.25 billion.
Okay, so that implies top-line revenue growth of somewhere between 7.4% and 8.8%.
Exactly.
Generating nearly 9% growth on a baseline of over $11 billion requires a massive, massive influx of new contracts.
It really does. But the bottom line projections are even stronger. They were guiding for adjusted EPS in the range of $5.36 to $5.50.
Wow. That represents 8.5% to 11.3% growth on the bottom line.
Yes. So they expect their profit growth to significantly outpace their revenue growth.
Which again validates the durability of those high incremental margins we talked about.
It proves the model is working.
Right. And there was a fascinating, highly technical nuance that Scott Garula pointed out regarding the 2027 calendar that I think perfectly illustrates how microscopically they track their daily operations.
Oh, the extra workday.
Yes. So Garula pointed out that fiscal 2027 happens to have one extra operational workday compared to 2026.
Just a quirk of the calendar.
Right. But because Cintas is a route-based service business that operates exclusively on business days, that single extra day of operations across their entire North American footprint adds approximately 40 basis points to their total revenue growth for the year.
Nearly 0.5% of growth just from one extra day.
The sheer scale of the operation means that just waking up and running the trucks for one single extra day is worth millions of dollars in highly profitable revenue.
It really highlights the compounding nature of a daily, recurring service model. The fixed costs of the facilities and the fleet are already amortized over the year, so that extra day is incredibly lucrative.
Pure profit, almost.
Yeah.
Before we synthesize all of this, we need to circle back to the fire protection services segment. We mentioned it briefly at the top, but it feels like the hidden gem within the broader Cintas empire.
It definitely is. As Jim Razakis noted, the fire segment hit an all-time high gross margin of 50.8% in Q4.
That is incredible for fire protection.
However, they were highly transparent with the analysts that the margin in this specific business will likely experience some volatility in the near term.
Okay, wait. Why would a segment operating at record profitability suddenly face volatility? That doesn't sound good.
Well, it's actually driven by two specific internal initiatives.
Okay, what's the first one?
First, they are implementing this massive new SAP technology platform across the entire fire business next year.
SAP. So for the listener, SAP is an enterprise resource planning software. It essentially acts as the digital central nervous system for a corporation.
Right. And implementing it requires basically ripping out legacy software and rewiring the company's internal digital plumbing.
Which is never easy.
Never. Management explicitly warned that this transition will create a 100 basis point headwind to margins. It is a painful, heavy upfront investment, but it's designed to yield long-term technological efficiency.
Yeah, software migrations are notoriously brutal. Everyone hates them.
Everyone.
But what is the second reason for the volatility?
The second reason is their aggressive M&A strategy within the fire segment.
Wait, I thought they were just doing organic growth.
In the core business, yes, mostly. But the fire protection industry in North America is currently highly fragmented.
Meaning what?
It is largely composed of small, local mom-and-pop operations. You know, a guy with a truck checking extinguishers in his specific geographic county.
Right.
So Cintas is actively acquiring these local businesses to consolidate them and build out a true standardized national footprint.
Oh, I see. But when Cintas acquires one of these local operations, the smaller business is likely operating at profitability levels far below Cintas's demanding standards. Like, a local guy with 3 vans and a whiteboard is definitely not pulling 50% gross margins.
Exactly. So in the short term, absorbing those less efficient mom-and-pop operations drags down the overall segment margin.
That makes sense.
But Cintas basically executing a classic private equity-style roll-up strategy, but as a strategic operator.
Right. They acquire the local company, rip out the old processes, implement the ruthless Cintas operational playbook,
Force them onto the new SAP platform.
apply their routing density algorithms, and over time just pull those acquired sluggish margins up to the 50% corporate standard.
That's the playbook.
That brings me to a quote from Todd Schneider that, for me, completely encapsulates the entire thesis of this company.
Let's hear it.
When he was discussing the fire protection business, he said, and I quote, "It's the only business that we're in where you legally have to have it."
Oh man, that sentence defines the ultimate economic moat.
Right. Think about the implications of that reality. You can technically run a car dealership without floor mats.
Sure.
Your floors will get dirty, and you might face a slip and fall lawsuit eventually, but the government won't shut you down today. You can let your mechanics wear whatever cheap clothes they want. You can force your general manager to go buy soap at the local grocery store. But you absolutely cannot legally operate a commercial building anywhere in North America without functioning inspected fire extinguishers and suppression systems.
Nope. If those tags are not updated, the local fire marshal will literally padlock your front doors and shut off your revenue stream.
The regulatory environment transforms the Cintas service from a discretionary, nice-to-have operational improvement into a mandatory recurring tax on the basic act of doing business.
They are essentially operating a private utility.
That is exactly what it is. If you build a business that the government legally mandates your customers must purchase from, and you manage to apply 50% profit margins to the delivery of that mandate,
You have achieved corporate nirvana.
you aren't fighting the client's procurement department for some discretionary budget. You are fulfilling a strict regulatory requirement.
And because you already have a Cintas step van parked out front dropping off the mechanics' uniforms anyway,
You simply bundle the mandatory fire inspection into the existing route and the exact same invoice. It is ruthlessly, brilliantly efficient.
it is the perfect synthesis of their broader strategy. They identify a mundane, friction-heavy requirement. They leverage their massive existing physical infrastructure to service that requirement cheaper and more reliably than anyone else.
And they turn a boring regulatory mandate into a high-margin compounding machine.
Unbelievable.
So let's bring this all together. What is the fundamental lesson we have extracted from spending the last hour dissecting the financial plumbing of the uniform and floor mat industry?
The primary takeaway, for me at least, is that Cintas wins by mastering the mundane.
Right.
They are not inventing the next generation of artificial intelligence chips. They are taking physical items that every single business needs, but that no business owner actually wants to spend mental energy thinking about. And they are executing the delivery of those items with brutal operational efficiency.
Completely brutal.
Through route density, stealthy cross-selling, and a relentless culture of positive discontent. They basically turn dirty shop towels and fire extinguisher tags into an economic engine that rivals the most sophisticated technology platforms on Earth.
They are living proof that you do not need a sexy, revolutionary product to build a spectacular, market-dominating business.
No, you don't.
You just need an unbeatable, highly disciplined process. And that leads me to the final thought I want to leave you with today.
Okay.
If you are listening to this, I want you to look at your own industry, your own daily operations, your own corporate workflow. What is the structurally invisible friction that everyone in your field hates dealing with? What is the equivalent of ordering toilet paper or checking fire extinguishers in your world?
That's a great question.
Because if you can build a system or a business or even just an internal process that completely removes that administrative headache for other operators, you do not just win a vendor contract. You do not just get a pat on the back from your boss. You become an irreplaceable piece of their infrastructure. You get inside the fortress. So ask yourself, where is the Cintas opportunity hiding in plain sight in your world?
The boring problems are almost always the most profitable ones to solve, simply because no one else has the discipline to solve them.
Exactly. Remember how we started this deep dive? Walking into that hospital, looking at the floor mats, the scrubs, the fire tags, that murky, invisible infrastructure.
Yeah.
It is not murky at all once you understand the underlying business model. It is actually a perfectly engineered, highly visible machine if you know exactly where to look. Until next time, keep looking.